What is a bond? A bond is a type of loan, but you are the lender. When you buy a bond, you're lending money to a company, a city, or even a government. In return, they promise to pay you back later, with a bit extra as a thank you. That thank you is called interest, and it's usually paid in regular amounts. These payments are called coupons. Think of a coupon as your paycheck for lending the money. It's the income you earn from the bond over time. So instead of owning part of a company, like with stocks, bonds are about lending money and earning steady repayments. UK government bonds are called gilts, US government bonds are called treasuries, and companies can issue corporate bonds. Why does it matter? Bonds can be a reliable way to grow your money slowly and steadily. They're often seen as safer than stocks, especially government bonds, because you're more likely to get your money back even if the economy wobbles. That's partly because of repayment priority. If a company goes bankrupt, bondholders get paid before stockholders. So while there's still risk, bond investors are higher up the line when it comes to getting their money back. People also like bonds because they pay regular income, like getting a small payment every 6 months. That can be useful for planning or for people who prefer lower risk investments. Bonds aren't just for individuals. Big investors like pension funds, insurance companies, and even governments use them because they offer a steady and predictable return. Here's a simple example. Let's say the government wants to build a new hospital but doesn't have all the money up front. So it offers bonds to the public. You decide to buy one for £1,000. The government promises to pay you 3% interest each year for 10 years. That means you'll get £30 a year for 10 years. At the end of the 10 years, they give you your £1,000 back. So in total, you'll have earned £300 in interest, and you get your full amount returned. And here's something useful. You don't have to keep the bond for all 10 years. Bonds can be bought and sold on the bond market, just like shares, though the price may have changed. What else should you know? Here's what else you should know about bonds. Their prices can go up and down, especially if you sell before they mature. An interesting point is that when interest rates rise, bond prices usually fall, and when interest rates drop, bond prices often rise. This means the value of your bond can change if you sell early. Not all bonds carry the same level of safety. Government bonds, like gilts, are generally low risk, while corporate bonds can be riskier, particularly if the company is struggling. This is due to credit risk, which is the chance that the borrower might not be able to pay you back. To help investors understand this risk, bonds are rated by agencies such as Moody's or Standard & Poor's. Bonds with high ratings, like AAA, are safer, while lower-rated bonds, often called junk bonds, offer higher returns but come with greater risk. To compensate for this risk, these bonds typically pay higher interest, also known as higher yield. The interest, or coupon rate, is the fixed amount the bond pays each year, but the yield, the actual return you earn, can change if you buy or sell the bond at a price different from its original value. So if you see a bond offering a high 8% yield, it's often a signal that the bond carries extra risk. The higher return is meant to reward you for taking that chance. Even bonds considered safe come with trade-offs. For example, inflation can erode their value. If prices rise faster than your bond's interest payments, your money loses buying power over time. While bonds tend to be steadier than stocks, they usually grow your money more slowly. That's why many investors use bonds alongside stocks, to help balance out the ups and downs of the market. Here's a quick summary of bond types. Government bonds are usually the safest option. Corporate bonds carry higher risk but also offer higher returns. Municipal bonds, common in the US, are issued by cities or regions. Inflation-linked bonds adjust their payments based on inflation to help protect your investment's value over time. To sum it all up, a bond is a way to lend money to a company or government and earn regular interest in return. They're seen as more stable than stocks and can be a smart way to add balance to your investment plan, especially if you like steady income and lower risk. Like all investments, they're not risk-free, but they're useful to know about. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description. Don't miss out.